Is that something that you would be expecting?
There will be a differentiation.
These should be the first ones that should come back.
At 5.6% higher than in 22.
That's the way how we would like to do it in the future.
They will perform really well.
40-year highs.
Why not think outside the box?
Be counter-cyclical as always.
Yes, maybe you lose 50 basis points, but in the long run, it won't matter.
Hello everyone, my name is Peter Oberlechner. I'm a partner in the real estate team of Theiss, a leading international law firm with 13 offices in Austria and Central and Eastern Europe. With me I have today Andreas Ridder. Andreas is the Austrian Managing Director of CBRE, the world's largest commercial real estate services and investment firm. And Andreas' knowledge of international investment markets is widely known. With me, I also have Erik Steger. Erik is heading the international real estate practice group of Theiss, and Erik has profound knowledge and experience in real estate transactional work in Austria and Central and Eastern Europe. Our topic today is the current situation of Austrian and European real estate commercial markets. Issues, trends, and also opportunities. Now, you all know the Chinese curse. May you live in interesting times. The Chinese origin of this curse has never been proven, but it's still an interesting curse. And it's very true for real estate, for commercial real estate these days. We have an array of factors that can also be labeled a perfect storm, basically. We are facing rising interest rates that have made debt considerably more expensive. We have staggering energy cost. We have high construction cost. Construction price index today is, as I just read, 5.6% higher than in 22, same time of the year. Inflation is still soaring. In Austria, we have a current inflation rate of 11.5%. Eurozone is at 8.5% at the moment. This is at 40-year highs. And clearly, this impacts also real estate markets. And last not least, the most saddest of the realities that we're facing is we have the war in Ukraine that is also impacting the European investment markets. All of this happens exactly at a point of time when the industry has just recovered from COVID. And some asset classes such retail and hotels have only begun to recover from COVID. Besides these problems, we're facing strong changes and change drivers such as ESG, digitalization, that are to an increased extent impacting commercial real estate. Now, for today's discussion, allow me to start off our discussion with asking Andreas to give us something like a snapshot picture of Austrian and European real estate markets and how the individual asset classes are doing at this point of time.
Okay, thank you. It's obviously a very broad question. You said they were just recovering, or we were recovering from the Corona crisis. Just to be a bit more precise, 2021 was the best investment market ever in Europe. So Corona has not in general been a big problem for real estate. It has been a problem for certain asset classes, but overall there were 350 billion invested in 2021 in Europe, and we have never had that before and after. So obviously, yeah, we are living in interesting times, and after Corona, we all had hoped normal times would come back, but now we have all these issues that you have mentioned, and for real estate, obviously, the main issue, it's definitely not the war. The war in the Ukraine, not even in Romania or Poland, so neighboring countries of the Ukraine. For example, last year we did the biggest ever real estate transaction in Romania, more than 400 million, CBRE selling to a local family. So the real estate markets are not directly impacted by the war, but indirectly, of course, because the war has helped the inflation to go up because of energy prices, etc. And the higher inflation has led to higher interest rates, and higher interest rates are leading to increasing yields, and that is obviously the main problem or issue that we are facing in real estate, because increasing yields means falling values and falling prices, and that is impacting everybody. Just on the, we all probably, I'm the oldest probably, so I have lived as a child in high inflation times, but I was not really doing business then, so living in a high inflation time puts many things in perspective. So for example, when we say that the yields are increasing and the prices are falling, that's not necessarily true, because in parallel to the increasing yields we have increasing rents, and we have many assets that we are valuing now where the value stays more or less the same, because the rents are going up steeply, especially in shopping centers that are doing well, but also office and residential. We all talk about this now, the steeply increasing residential rents. That very often leads to same values, and then most people say, oh, that's fantastic, so the values are stable. But when we are talking about nominal values here, but real values obviously fall dramatic. If you have an inflation of close to 10%, or like in Hungary, more than 20%, and values remain nominally stable, that means a steep decrease in values. So that's the general environment, and inside then the different asset classes, there are obviously different things going on. Maybe the most general interesting thing to mention in the beginning, normally when we have entered, so I've been in real estate for more than 30 years and I've seen many crises, but normally when a downturn came, we had increasing unemployment rates. We had a lot of people looking for jobs and couldn't find them. We have the opposite now. We have the lowest unemployment rates almost in every country in the US. Salaries are further, or even more increasing because of this war for talent that we are currently seeing. Then also for example, in the offices in most countries, normally when a crisis came, we had a big development pipeline because we had many good years, everybody was starting to build, and then most things were completed when the crisis was there. Now it's again the opposite. There's hardly any development pipeline in office anywhere in Europe or US. There's a low vacancy rate, so there are quite a few unusual things going on at the moment. So when I now, sorry for the long introduction, when I now look at the asset classes, so normally the biggest and most important one is offices, and offices is going through a very special trend. As I mentioned, this low vacancy rate in Vienna, for example, we have now 3.9%, the lowest ever. So there's hardly any offices available. This year, 40,000 square meters will be built in Vienna. The annual, what we let in Vienna, or the market absorbs, is about 170,000, 180,000 per year, 40,000 new coming. So there's no product. Rents are steeply increasing. Never ever in my more than 30 years I've seen such a steep increase in office rents in Vienna. For example, where we moved from the city center to the Hauptbahnhof 2 years ago, but we signed the lease contract 4 years ago, and we signed the lease at 1650 on the top floor, views over the entire city, so very nice. And today this probably would be 24 euros. That means in 4 years, 45% rent increase. So that has never ever happened. And the rents are, it's not now a peak and they will fall over the next 6 months, but the rents are further increasing. And why is that? So one reason is the limited product, and the other reason is this war for talent, that nobody finds staff anymore. And those companies that are doing well they all need to do something to attract new staff, and this new staff, one reason why they would decide for an employer is an attractive location, an attractive office with lots of amenities, etc., etc. So that is, we can later talk about further aspects of the office market. Residential, probably the other or the second biggest in Austria over the last years, the biggest asset class as regards the investment volumes. Residential going through also an interesting time, mainly because of the steeply increasing rents, because of inflation. Can tenants still afford that? There's a lot of political discussions in Austria, in most countries, how to support tenants now, or tenants who have not much income, to still make sure they can afford their apartments. So the big question there is obviously rents are increasing, but on the other hand, supply is also fading away, because many developers have announced over recent weeks they cannot afford anymore to build because of the high construction costs. So lots of things going on in the residential market. The retail market, having gone through the biggest crisis ever in Corona times, just were starting to recover. So the footfall and the turnovers are now above before Corona, but then again, taking into account inflation makes everything relative again. And there is also, there's this big trend going on everywhere in all aspects of the economy and the world, unfortunately. So the top, the rich, they're getting richer. The top people, they're better and better off. The poorest are getting poorer and poorer, and the middle class is somehow fading away. And that's what we see in office. We see it in retail. In retail now specifically, the top segment of the retail market booms. So Vienna inner city, we all thought these rents are absurd, but they're further increasing because there's so many international top retailers who want to, and it's the same for everywhere. It's not just Vienna. Vienna is in most cases just an example. And then there's very cheap retail, works really well because there are more and more people who have to be really cost conscious, and the middle fades away or dies, and that means that many of the big retailers now have less shops, so they reduce the number of shops, and they want to be in the best locations, the city centers and the big shopping centers. They all thrive, they all do extremely well, but middle locations, okay shopping centers, they have problems. So that's in general the retail market. Hotel had obviously, that was the worst affected asset class in Corona. They have recovered rapidly last year. A lot of people called this revenge tourism. So after these 2 years of really terrible hotel markets, everybody wanted to live again and enjoy lives. And so room rates in Vienna are above where they were before Corona. The occupancy rates are close to where they were. So that's in principle all good. However, the business travel probably will for a long time not come back where it used to be. I don't know how it is for you, but at least for us, there's a big focus now on not traveling that much anymore because we have all proven it works with video conferencing. We can do most of the things than ESG, so we all have to be carbon issue conscious. So the business travel will for a long time not be as good as it was, but tourism makes it more than good. So sorry I'm talking so long about logistics. The other winner of the Corona years, because in general, when you can't go shopping, then you buy online, and every online delivery needs a warehouse. The warehouse demand exploded in Corona and is still extremely high. In Austria, we hardly have any vacancy. I think it's about 1% or below 1%. This year, so last year 150,000 square meters of warehouse were built. This year it's 250,000, but we have a demand list of 900,000 square meters of tenants looking for warehouse space. So there's many more times demand than supply in warehouse. Again, rents are exploding, going up, and it's more and more, on the other hand, difficult to produce, not so much because of the increasing building costs, but more because of the difficulty in finding sites where you still are allowed to build with this what we call brown fields and green fields. So it's there are more and more laws, as you know better than I know. Everybody, and also Austria, wants to reduce the consumption of green field and limit this over the next years. Therefore, it's more and more difficult to get planning consents for warehouse construction, and therefore supply will be very limited and demand is only going up. And then there's ESG, but let's talk about that later. Sorry,
maybe Andreas, two quick maybe supplementary questions. When I had mentioned the war in Ukraine, this was also before the background that what we had heard, at least at the beginning of the war, when this terrible thing began about a year ago, Europe seemed to have been declared as a war zone as a whole by some Anglo-Saxon funds and investors who signaled to us, and we saw some interesting transactions collapse on grounds of the fact that, where we live was no longer deemed to be safe. Now you described, the picture that you gave is that the effect of the war was not this direct one that has to do with investment decisions. Is this true also for Anglo-Saxon investors, according to your view?
I'm not aware of that, and I don't have the exact numbers. I told you in 21 was the best year ever in Europe.
That was before.
As relates to investment volumes, and obviously 22, the volumes went down by, I think, 25-30%, and I'm almost certain that in the US the numbers went down even further, and in Asia about the same. So I cannot tell you that we have in Europe a war impact on investment volumes, and I haven't really seen it.
And the other thing that kind of is striking is that the picture that you described, rents increasing basically steeply, one should think that this creates hunger for investment, for acquisitions, expecting rents to be higher also in future. But still, what we see is a certain standstill, and that's not only related to Austria. We're told the same by colleagues basically throughout Europe. On the transactional side, there is relative silence at the moment. What's the reason for this?
Yeah, that I can completely confirm. So not just Europe, I think worldwide is more or less a standstill yet. The reason is, so we call this a price exploration phase. So all the investors currently discuss and think at what price should we start investing, because the assumption is interest rates will go up a bit or a bit more, and yields will therefore have to go up a bit more. And when will the peak of the yields or the low point of the values be reached? And at that time we want to start investing. We internally believe that in the second half of this year things will start again. The main reason why we believe that is that there's a lot of money in the market available to invest. It's only being held back at the moment. And we do every year an investor intention survey at the beginning of the year where we ask the biggest 300 European investors, what are you planning to do this year? And they answered in January. So 59% said they want to invest this year more or the same as last year. So that means most want to do something this year. And if they don't do it in the first half, the pressure to do it in the second half will only increase. So we expect a very busy September to December period.
Mm-hmm. Thank you. Well, maybe now turning to Erik. Erik, your profession is the law, basically, and
as is yours,
and as is mine. It's a kind of a grassroots view that we have when we do our work. What trends and developments do you see on the legal side at the moment? Is there any specific observations that strike you?
Well, basically transactional work is significantly less. There is much more work that deals with asset management, optimizing things, making things better, making them rounder, making them more attractive for future transactions that are about to come, hopefully in September, from September onwards. And until then, there's kind of time to do some housekeeping, and that's what many real estate developers, owners, investors do. What do they have to do? First, I think we are still in the aftermath of COVID, which means that there are some disputes to be settled about rent that has been payable, yes or no. There is a lot of questions, how do we deal in the future with a similar situation? We see that a lot in contract negotiations, force majeure clauses that used to be extremely boring for clients to listen to suddenly have the full attention of the clients. Okay, how do we deal with such a situation? In the countries where there were government grants, the question is, okay, how shall we deal with them in the future? Should we face another crisis where the government issues money to whatever side, be it the landlord, be it the tenant? How will we share it, if at all? What will happen with that? So it's a lot of legal discussion, how to allocate risk properly. And many times you will have heard in negotiations that that's the way we always do it. That suddenly does not apply anymore, because there is a new level field of where people put their cornerstones and say, okay, that's the way how we would like to do it in the future. And there is no settled market usance now in the countries as far as I can tell. Inflation means a lot more than an impact on every one of us in relation to real estate. Why is that? Number one is a discussion whether full inflation should be passed on to tenants, yes or no. Is that fair? Is that attractive? Is it sustainable? You spoke about ever-increasing rent, now paying 24 euros per square meter in the main station of Vienna. Can anybody afford that? If I listen to what you say about market supply, then probably you have no choice. You have to do it or just leave Vienna, go to the outskirts, and you will get it cheaper. That's one discussion. Another discussion is for developers when they sign a lease now, like you did 2 years before you moved in. What happens until handover? Is that inflation taken care of, yes or no? Will we not know today with what rent we start? Will that be inflation based, yes or no? And if so, how much of inflation can the developer pass on to the tenant, thereby mitigating the developer's risk of an increased cost to put the building there in the first place? And a second impact that this increase in inflation as well as interest rates has is that the financial markets react to that as well. Why is that? The loan-to-value ratio is not functioning anymore. Many of those who hold real estate and have leverage in it, they suddenly are defaulting under their financial covenants. and therefore they need to sell at a certain point of time. Now they're still asking old prices, whereas buyers are waiting for prices to become much lower. So there is nothing really going on, but at one point in time, you know, the stress of being under a financial default becomes untenable, and the stress of not having invested into anything becomes untenable. And this is where I too believe transactions will start to happen naturally, and then we will see a price coming out of this, which will be painful for those who sell and more interesting for those who buy, I would guess. And we do have, from a legal point of view, we have a very strong question mark because of, you mentioned that as well, the lawmakers everywhere trying to make sure that renting remains sustainable in the long term. And there are all sorts of, shall we put a brake on rent increases? Shall we disallow rent increases? Shall we subsidize one or the other side? Shall we subsidize energy? Shall we subsidize making buildings better from their energy consumption in order to help make savings there? All that results in a lot of uncertainty from a legal environment, because many things are questioned now which have not been questioned 2 years ago. And that, I think, also prevents many people from doing investments because they just don't know whether they will be able to achieve the rent, for example, that they today think will be the rent in 2 years if everything would stay the same.
You had mentioned the discrepancy of the fact that some took loans when interest rates were zero and now have to pay considerably higher interest. Remembering what was speculated about more than 10 years ago when there was Lehman, the crisis that was limited to financial markets then, was the question of whether there would be fire sales at some point of time, whether there would be kind of emergency situations for people holding real estate or developing real estate at a certain point of time. Is that something that you would be expecting in the situation that we currently have?
Well, I think Andreas will know quite many things as well to say to that, but from a law firm's perspective, as we in Theiss see this, there will be a differentiation between the markets, Austria and immediate neighbors, and further away, in the sense that it appears that, again, banks and owners just hold on to their positions. They do not engage in fire sales, and the legal framework allows them to do that. It's not necessary for them to transact, to panic sell things really, whereas in some countries with more Anglo-Saxon background, banks have a tendency to really offload their balance sheet from non-performing loans, and there we could see more portfolio transactions where loans are sold and through the back door real estate is sold.
Is this
Would you agree?
Yeah, so I fully agree. So in general, in particular, the Austrian banks have never, over the last, since I'm there, 35 years, have never followed this fire sale and pressure on their clients to force them to liquidate, because they have always argued it would hit the bank even more if prices collapsed. Then it would be more a problem for the bank than of the individuals. And obviously the Anglo-Saxon banks have a very different attitude. For the markets, it would be much better to follow the Anglo-Saxon approach, because then things are quickly solved and back to normal business. In Austria, currently the Zinshausmarkt, these old buildings, is probably the market that's impacted most, because again, banks have financed up to 100% or 105%, including acquisition costs, and the yields there maybe 2%, and many of the borrowers have had flexible rent agreements, so the maths are easy. If you have a 2% yield and now have to pay 4% interest and don't have much equity, then you have to do something, and that's what we are seeing. So there's lots of product in the market. Nobody's buying at the moment, so all the Zinshaus agents, they all have terrible problems because there are no deals happening since 6-9 months, and prices are falling, but obviously not rapidly enough for some of the professional investors are waiting on and waiting to see what's happening. On the bigger front, what's interesting, many of these bigger professional investors in the CE region, they not here, but here I know best, not only here, but here I know best, they obviously have issued bonds, big bonds over recent years, and I'm aware of some who have hundreds of millions of bonds at 0.6%, 0.7%, 0.8%, which will mature in 1, 2, 3 years, and then obviously it will be interesting. They need to refinance. They will be far, far away from these low interest rates. What will they do? So there some stress is on the horizon, but it's not imminent because most of these bonds don't mature this year and some start to mature next year. But there are obviously scenarios where it's definitely not as profitable anymore to be an owner of real estate as it was with these absurd low, especially in CE, when you finance at 0.6% and have yields of 5, 6, 7, 8%. It's a dream business model that used to be, but that's not existing anymore.
Yeah, that's very interesting. We had already touched upon market outlook, and you had mentioned that you would be expecting more transactions or many transactions, as I recall, in the second half year. When we apply the yardstick of, let's say, asset classes and countries to the current situation, are there markets, are there asset classes where you would believe that things would be picking up more quickly than others, or is this kind of a level playing ground for everybody everywhere when looking at the European markets?
No, in general, there should be differences, and mainly from the demand side or the vacancy side. So those areas where there's a lot of demand and a lot of vacancy, not a lot of vacancy, or not much product, and the expectation of rents to further increase, these should be the first ones that should come back. So offices. And in many countries, logistics definitely. Hotels is improving as well, but it's not that 100% certain, but it looks very good for especially leisure hotels, not so much, as I mentioned before, the business hotels, but leisure, and not only the big city centers, but coastal things, etc. That all looks very positive. Retail depends, I would say, because in general we have enough retail space in Europe, so there's not an undersupply of retail space. As I said, the best retail, because of this trend, that's less shops for the big retailers, concentrating on the best locations. So these best locations, best shopping centers, they will perform really well, and we expect deals to start happening in that segment. And on the other hand, the really cheap, the retail parks where you have supermarkets that always work well, so the supply of the neighborhood schemes, they will work well, but again, the middle ground, the smaller shopping centers, we all know some of them, that will be difficult. Residential will always be, so it's interesting, residential, because when I started, as I said many times ago, more than 30 years, there was this, everybody said, international investors don't invest in residential outside their home country because of the political risks they were afraid of. They said in their home country they have a feeling what could happen, but if, like now, or if there's a special sort of government, they could say all the owners, foreign owners of residential properties are not allowed to increase the rents. So things in populist governments could be thinkable, and only local landlords are allowed to, for example, to increase rents. So that faded away over the last 10 years. So everybody was investing everywhere, and residential has become a very international market. And that's probably here to stay, but with this in general phase now, which is now the general difficult environment. In a difficult environment, investors tend to invest at home, not only residential, but everybody. And that now reminds me of CE. When the 2008-9 crisis came, CE was hit much harder than Western Europe, and the main reason was they had no local investors. I think 80-90% of the investors in CE were international investors. They all went away, and there was hardly anything left to buy things. This has luckily changed completely over the last 15 years. Last year, I had a note here, 77% of the investors in CE were local investors. So that's very positive for the market. That's an amazing change. Yeah? And that's really, really positive. Therefore, I'm certain that CE in this phase will not suffer more than Western Europe. And we also see it up to now in the yield movements, that yields have not increased more than in Western Europe, and sometimes even less than in Western Europe. So that's a very positive aspect of things.
There is, I had mentioned this before, there is, of course, a buzzword now in the industry that kind of is mesmerizing everybody, seems to be mesmerizing everybody, ESG. One of the assumed change drivers for the next years. Erik, what's your expectation? What will ESG, will this remain basically just a buzzword and a nice label for categorization of buildings, old or new? Or is there substantial changes that can be expected from ESG?
I'll try to be as legal as possible and leave it to one of you to chip in the economics. ESG is not a buzzword anymore. It is a necessity, and it's a legal requirement to the extent that it exists and that it becomes clearer and clearer. It started off with a very vague and ambitious target setting. That's what we want to achieve in Europe. It then kicked off asking banks and funds to comply with certain criteria, which became more and more clear. And now, since the beginning of this year, we have the next wave of what does it really mean, what you have to do. And while 5 years ago, whether you want a certificate of platinum or gold or whatever on your new building or not was a question, do I want to pay that another 150,000 euro, yes or no? Is it really necessary? Today, you probably are unable to sell a new building unless you have that certificate, so it's a given. And you start to really get cheaper financing if you comply with the criteria of a certificate, and banks must check that, must in their compliance regulations explain why they charge this and not that interest rate, for example. So it becomes tighter and tighter from a compliance necessity, from a legal compliance necessity. Mm-hmm. Would you see this too?
Yeah, but from even more so from the market side. So when I look back a few years ago, ESG was more or less just to get a nice plate at the entrance door to be proud of or to show off. And even we as a firm advise developers what kind of high certificate can you go for to invest the least money. So everybody just wanted to have gold or platinum on the building, and they didn't care about much more. Today, this is very different. So as you say, the banks ask for it, but not only ask for it, you get cheaper finance when you have an ESG compliant building. You get higher rents because demand is higher, because many, for example, a company like us, we have in our internal rules that until the end of next year, all our offices have to be in ESG compliant buildings. So we couldn't even rent anymore. And that's true for probably many or most of the big international companies.
So you would have had to move out anyhow.
Yeah, so luckily we did
from
it.
your old location.
We did it before. And the purchase price, so you get, and there already we have done studies, so you get a bit higher purchase price or a bit lower yield when you sell an ESG compliant building. So there's immense pressure on everybody. There's a lot going on. It has a lot of impact. So the normal one is now, for example, in Austria, or the big international funds who own properties here that are not ESG compliant, they have to either, they call it manage to ESG, so invest or sell. Many of them who don't have strong local teams, they rather sell and let a local developer do the hard work. Some have bigger teams, they do it themselves here. So there's a lot coming out of this aspect of ESG. But this is most of what I now have discussed is the E in ESG, the environment. The S, the social, there's a new thing that has only started last year, that if you have a tenant in your building that is, from an S point of view, not good, like a tobacco company or an oil company or maybe a Russian company or whatever, so they can think about the S, not so good S companies, then when you sell the building, you have less investors and you get less good prices, and that now leads or begins to lead such companies when they want to rent space, they either have to pay more rent to compensate the landlord for the damage they're basically doing to the building, or something else that could happen where we see first indications, they now begin to buy again. Especially energy companies, they have so much money anyhow now, which they made last year in the energy crisis time. So that's one interesting new aspect that has come up over the last year. And another one I just read about it last week, and it's really interesting, all the things that impact on, that ESG impacts on. This carbon offsetting is obviously a huge business. We all had last year in our company, we had to do a Cambridge ESG course, and there we learned that many of the offsettings is a hoax. So it's, for example, US National Park sells rights to offset carbon, but they would never cut the woods anyhow, but they just get the money and nothing has changed in the atmosphere. So there's now more and more scrutiny when you look at this carbon offsetting things. But what I read about New Zealand, for example, there the carbon offsetting price is relatively high because there's a lot of it's a pretty green country, and that means now a lot of investors buy farmland and convert it into woodland, and therefore can get the carbon offsetting money. And that means that less and less farmland is available for cows and sheep, and so meat production, and they are already fearing it at some point this might become a problem. But on the other hand, when you think about it, the less cows are being produced or grown, the better it is again for the climate. But these indirect, complicated impacts of ESG are really interesting to watch, and obviously the next years will be this will be our main topic. When I have a client meeting, I always say as a joke, but it's mostly true, after 2 or 3 minutes we start to talk about ESG, or the client starts to talk about ESG, and then we don't talk about much else anymore, because it's the main important topic at the moment.
Yeah, and probably looking at the state of the planet, this is absolutely understandable. Now, is there, when speaking about current issues of commercial real estate, is there anything that would come to your mind that strikes you, that needs to be mentioned, that we have not yet touched upon?
Well, it's a part of the same issue that many tenants traditionally were looking for the rent number and were less concerned about the additional cost for heating, cooling, warm water. I think that has changed now, and they will want to know how efficient the building really is. And I wanted to ask you, do you have a sense whether marketing of available space would become easier if you would give a total number?
You mean rent including service charge?
Rent including.
Yeah, but most tenants do that calculation anyhow, so you don't have to put it into one number. And that's, for example, a lot of people are beginning. So in the end, obviously, the more efficient the building is, the more ESG compliant, the lower the service charge should be, and therefore the higher the rent should be. And on top of that, even higher, because you get more potential tenants. But there are now beginning discussions about these old inner city Zinshäuser, which you probably will never be able to turn into full ESG compliant, low energy buildings. What does that mean for them? It's obviously difficult to predict, but I assume because normally the locations are so much better, potential tenants are willing to pay more service charges to be able to live in such a nice inner city location. But the impacts are very wide, of course. But when you ask other topics, I would say one big topic is construction costs. They obviously have exploded in recent years. You mentioned they're still a few % higher than last year, but they're beginning to fall. So, for example, steel is already post-war, so at the price pre-war, steel has exploded, now has fallen back. And interesting to watch this or to analyze this in detail. So when you look at the different aspects of construction, so one aspect is labor. So we have one project, a big one in Vienna, where labor is 60% of the construction. So labor obviously is not falling. Labor costs are going up due to at least in parallel with the inflation. But other, for example, the ground digging, the earthworks, they have already fallen considerably, because it's falls with the proceeding of a construction, because those who are in the end phase, electricians and ventilation, they still have full books to work. But those at the start of a construction, so groundworks, the pure construction work, in those areas, prices are falling rapidly. In the electrician, ventilation, these specialists all have full books, but this will fade away over the coming 6 to 12 months, and then they will become cheaper again. So we see, luckily, finally, that construction prices are beginning to fall, which will help further supply, because BUWOG is the biggest developer of residential in Austria. They announced a few weeks ago they cannot build anything anymore, because at the moment it's not feasible to build with those high construction costs. So we need desperately falling construction costs, and they should be coming.
To end our discussion that could be going on for, I would say, a long time more, with a tough call to basically both of you. I would be asking you for 3 grains of wisdom for market participants. Now, I mean, I'm not wanting to be funny. Should there be a piece of advice that you would want to give to market players, be they developers, be they investors, be they engaged in whatever formal manner in this industry of real estate at this point of time, what would it be?
We didn't prepare that.
Would you like to go first?
Poor advice to be given.
Oh, yeah. So sorry, I didn't prepare myself. So probably one thing is to do something unusual. So not to build a standard office building or a standard retail park, but to do something special, something different that might be something with ESGs or the ultra energy efficient building, or from a marketing perspective. For example, in Vienna, we have a developer who is really clever, who builds a building for Philharmonica, so for musicians who need to practice at home, and they cannot do it in normal buildings because, I don't know, you know better, after 5 or 6 or whenever you are not allowed to make noise anymore, and they build them sound insulated so they can practice day and night. And this building, there's a huge demand already just from musicians to go into this building, or they build another residential property where they engaged Andre Heller to build a special beautiful garden, and just because he's doing this and the location is not great, but the sales are exploding still, when we see in other areas that sales are getting slower for apartments. So doing something unusual, doing something what nobody else has done yet. So that's a very general advice. Obviously, it's not easy to do something that nobody else has done before, but that's definitely an advice I can think of. Then, yeah, be counter-cyclical as always. So you probably, those who start investing first, whenever it will be in September or November, you then will be able to really buy the best of the best, because there's so much in the market, or not even in the market, but we see, for example, very clever international investors now looking at just the best properties. Also in Vienna we are selling one, and I said, why are they analyzing it? Because they would never pay this high price that would need to be paid. But they do it all over Europe, and I'm sure one or two or three at the end of the year they will get really the best in class quality at a relatively interesting good price, because someone will get nervous and someone will need to sell quickly. So just try to concentrate on the best quality and go after it, and you might get lucky.
Yeah, that's certainly really valuable advice. Erik, is there anything that would come to your mind?
Well, I think my first answer would be don't panic. This is the fourth crisis that I see, if we may call it a crisis, the fourth market circle downswing that I experience in my professional life. And there is no reason to say this time is different. It will go back up again necessarily, and then maybe we will see yet another market circle come while I'm still active, or maybe another 2 or 3, who knows. So don't panic, things will gradually improve. I also share the view that there is, like in securities markets, it's virtually impossible to find the optimal spot to invest or to divest. You will always miss it to some extent, except for a few extremely lucky ones. So why not be prepared now? Why not start looking at things now? Why not think outside the box today? Yes, maybe you lose 50 basis points, but in the long run, it won't matter. So that's what I would say.
Then one thing, we haven't talked about home office and war for talent and all the impacts it has on office space. It is clear that the best companies need the best people, and the best people, we all don't know where they have gone to, but they don't work as much anymore. They're on holidays constantly.
No, we work here.
Okay, but finding them and attracting them, it gets more and more difficult. And I think you have to concentrate on them and do everything you can to get them into your company. And that has many aspects, obviously, but one is the office space itself. And the best-in-class companies, they really do a lot on that front. So I always say, when you go to a hotel, you're willing to pay to stay in that hotel, and therefore the aspiration should be an office should be like a hotel where you can go to for free, but feel as good as you feel in a great hotel. So that's and when you look at the best new offices, they look like hotels more and more. When not the bedrooms, but they also have bedrooms, but not many, but a few. But just the reception areas, the eating areas, the relax areas, and that is really makes a huge difference. I think, and that's more and more important. And there's a lot going on. So it's ESG is probably the number one topic, but the number two for us as an advisor is to convert all the offices into cool, new places where people would love to go to.
Thank you. I think these are really valuable thoughts. And I want to thank both of you for your time and for your energy and for your thoughts. And I hope that also for the people who are watching this, there is something in it. Thank you very much.
Thank you, Peter.
Thank you for your invitation. Thank you.